All right, let's dive into a major puzzle that's facing every single investor right now. The market is hitting all-time highs, which is great, but at the same time, the Federal Reserve is signaling that it's getting ready to cut interest rates. Now, that's a really rare and honestly a challenging paradox. So today, we're going to build a blueprint to help navigate it. I mean, this is the big question, right? It's what everyone is trying to figure out. Normally, you see rate cuts when the economy is in trouble, when stocks are falling. But today, we have the complete opposite, and this weird situation creates a pretty precarious environment where, frankly, the old playbooks just might not work. Understanding this contradiction is absolutely key to making smart decisions. So here's how we're going to break it all down. First, we'll dig into the paradox itself. Then, we'll dissect what's really driving this all-time high. From there, we'll look at the two likely roads the Fed could take us down before we start building a robust plan. First with some defensive pillars, then with some smart tactical opportunities, all leading to our final investor's blueprint. Okay, let's get into it. We're starting here because this isn't your average market. It's a rare and challenging environment that really demands a more thoughtful approach than just, buying an index fund and hoping for the best. It really boils down to this simple but kind of scary equation. On one side, you've got peak valuations. That means stocks are expensive. They're priced for a perfect outcome. On the other side, the Fed is talking about rate cuts, which is usually a sign of economic weakness. When you put those two together, you get a really precarious situation that challenges all the traditional strategies and honestly creates an environment where the risk of a policy mistake is pretty high. So let's talk about this all-time high. Just how fragile is it? I mean, the market looks really strong on the surface, but we need to peel back the layers a bit and see what the foundation actually looks like. And when you do, wow, the market's entire advance has been powered by just a tiny handful of stocks. You can see it right here. The Magnificent Seven have seen earnings growth soar by 26%, while the other 493 stocks in the S&P 500 barely grew at all, just 1%. This extreme concentration is a major risk. If these few giants stumble, the whole market could easily follow them down. And it's not just about concentration, it's about sky-high valuations. Key metrics are in their 95th percentile. To put that in perspective, we're talking about levels we haven't seen since the speculative peaks of the dot-com era. In short, the market is priced for absolute perfection, which leaves very, very little room for error. So this combination of record prices, concentrated leadership, and all the hype around a hot theme like AI has of course sparked the big B-word debate. Are we in an asset bubble? This puts the Federal Reserve in an incredibly tough spot. I mean, if they cut rates into a frothy market, they could be seen as pouring gasoline on the fire. But if they don't cut and the economy weakens, they could be the ones to trigger a recession. It's a real catch-22. This really puts the Fed at a critical fork in the road. And the direction they choose with these rate cuts will likely send the market down one of two very, very different paths. If you look at history, when the Fed starts cutting rates, one of two things usually happens. In a soft landing, they pull it off, the economy avoids a recession, and stocks have historically soared, averaging a massive 20.6% return over the next year. But in a hard landing, the rate cuts just aren't enough to stop a recession, and returns are way, way worse. Right now, the market is priced for that super optimistic soft landing. But here's the kicker. There's one thing that happens in both of those scenarios. Volatility spikes. The very act of the Fed shifting its policy creates a ton of uncertainty. So no matter what the final outcome is, you should probably prepare for a much bumpier ride in the months ahead. Okay, so with volatility on the horizon, the first step is to prepare. And that means building a solid defensive core for your portfolio, using some key pillars of stability. The first pillar is gold, and the key thing that drives its price is something called real interest rates. Look, the simplest way to think about it is this. When the return you get from other safe investments goes down, holding gold, which pays you nothing, suddenly becomes a lot more attractive by comparison. And that relationship is incredibly powerful. A 1% drop in real yields has historically led to an 18% jump in the price of gold. And since we know the Fed is about to cut rates, the outlook for real yields is down, which makes the case for gold fundamentally bullish right now. Our second pillar is bonds, and the key concept you need to know here is duration. The best way to think of it is like a lever. The higher the duration, the more a bond's price moves when interest rates change. And when you think rates are about to fall, well, you want a longer lever to get more upside. So here's how it actually works. The Fed cuts rates, which means new bonds being issued start paying less interest.
that suddenly makes your older bonds, the ones with those higher payouts, way more valuable. And so, their price goes up. In this kind of environment, adding duration is the most direct way to position yourself for those potential gains.
All right, so we've covered our defensive core. We've battened down the hatches. Now let's pivot from defense to offense. Where can we actually find some intelligent returns in this really complex environment? A key barometer to watch here is the credit spread. It's basically the extra pay you get for taking on the risk of a corporate bond instead of a super safe government bond. And right now, these spreads are near 2-decade lows. That means investors are showing very little fear. They're not getting paid much to take on risk, which is a classic sign of major complacency in the market. Now, on the stock side of things, an even more interesting tactical play might be in small cap stocks. After years of underperforming, they are now trading at a massive discount to large caps. In fact, it's the widest gap we've seen in over 25 years. Now, if we do get that soft landing we talked about, these smaller companies could be poised for a major comeback. But, and this is a big but, this is a higher risk play that is totally dependent on the economy avoiding a recession.
And hey, remember that rising volatility we talked about? Well, it makes options more expensive. Now, that's bad news if you're an option buyer, but it's great news if you're an option seller. This opens up some interesting strategies that can let you generate income from that higher volatility, which is a perfect setup for a potentially bumpy sideways market. Okay, it's time. Let's put all of these different pieces together into our final blueprint for the resilient investor. So, building a truly resilient portfolio for this kind of environment means going way beyond a simple stock and bond split. This framework combines a core of high-quality global stocks with strategic positions in gold and bonds to defend against that volatility. Then it's layered with tactical plays, like those small caps and option writing strategies to try and capture potential upside. Ultimately, success in this kind of environment really just comes down to discipline. This quote says it all, doesn't it? Trying to perfectly time the market is a losing game. The goal isn't to predict the future with 100% accuracy. It's to build a robust plan that can handle multiple different scenarios, and then have the discipline to stick with it. You want time, not timing, to be what drives your returns. And that really brings us to the final question. With this strange paradox of peak valuations and looming rate cuts, you really have to ask yourself, is my portfolio actually built for resilience? Or is it just kind of hoping for the best? And that, right there, is the key takeaway.
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.